Hey, good evening, everyone. How are you all? Good evening, Hardik. Good evening, Pranav. Are you all good? How are your studies going on? All is well. I hope everything's fine at your end. So we have been covering this journey of financial management since a few days. Okay, so we have covered the sources of finance. We've covered the scope, objectives of financial management, right? Then we have also completed a topic called as ratio analysis, which was about analysis of the financial statements. And in the last two sessions, I think we have completed the cost of capital chapter, right? So this has been a journey till now. So right now, let's just take it forward with another topic, interesting topic called as capital structure. Okay. Problems of capital structure will be taken in the sessions that we have for revision of it. Okay. Ratio analysis, solutions of the remaining questions. We'll be uploading it on our viewers portal after the revision class gets completed on Tuesday. So when your revision class is going to get over on Tuesday, then I'll be uploading the solutions. Okay, just wait a moment. Yeah. Okay, so right now let me get started with capital structure. Then towards the end of the session, we'll take up the queries that you have from the other topics, or maybe this topic also. Okay. Yeah. Yeah, awesome.
Good evening, sir.
Good evening.
My first class of yours.
Okay.
So, sir, would you suggest me how to join? For...
So
Shall I start it by all classes, or
no.
shall I
Have you
got it?
Have you viewed at the videos of the previous lectures?
Not yet.
No,
Sir.
not yet.
Today I will be starting then.
Okay, so I think you should be able to get the things, but somewhere or the other you may find that some Hebrew or Latin language coming your way. Possibly some certain words may not be easily understood by you. But never mind, stay connected, stay there in the meeting, do attend it. And I think it's
after this, sir, I will complete that all lecture.
Okay, so don't worry.
Sir, can I continue with this?
Yes, you can.
Okay, sir.
टोटल कितने सेशन हो गए FM के? I don't keep a count, but I think it is 5th session today. Yeah. Happy Navratri, Hardik. Yes, Abdullah.
Hello, sir.
Yeah.
Sir, is there any way to remember the formulas quickly?
Which formula? First of all, it's not formulas, it's formulae.
Sorry, sir. थोड़ी मैं हिंदी मीडियम से तो थोड़ी इंग्लिश कमजोर है. तो कोई रास्ता है कि पूरे FM के जितने भी फॉर्मूले हैं अच्छे से याद किए जाए जल्दी से?
Don't try to by heart it. Don't try to remember it. Okay. Ensure that you understand it logically. And as you do the questions, you need not buy out any of the formula. You need not, mug up any of the formula. All of them are, quite logical enough. Okay, because once you start, mugging up or maybe memorizing the formula, then it will be a problem for you, because then दिमाग में तेरे chemical लोचा हो जाएगा. Okay, so you will find yourself at the receiving end because formula may get just jumbled up. So remember all the formula with logic. Okay. Yes.
Sir, can you upload extra question answer? Sir, answer when I do answer is
For
match.
which questions? Which questions?
Sir,
Sure.
chapter number 2, 3 and 3 का sir ratio analysis.
So ratio analysis is yet to be uploaded. So we have the revision session of that on Tuesday. So in that revision session, I'll be doing the questions of the ratio analysis on that. And then after that, I'll be uploading the solutions.
Okay, sir.
Okay.
Okay.
Sure. So let's proceed now, guys. Let's get started with this interesting topic called as capital structure. Okay. This topic, capital structure, is going to be really interesting to learn, and we'll try to visualize a lot of things into it. Okay. There are definitely certain formulae in this. Okay. So, but you need not worry about it, because those formulae are again going to be logically derived by me, just as we are been doing since the previous sessions. So let's get started without any more discussion. First, we talk of the word capital structure. So when we say capital structure, what do you really mean by it? What do you really mean by the word capital structure? Yeah. Capital structure means structure of capital. Right? So you mean the capital structure means structure of capital. It means simply how your capital or investment in a business is structured, or I can say out of your total capital, what is amount of debt, what is the amount of equity, what is the amount of preference shares that we have, right? So basically the pattern in which capital or the funds have been raised by the company, right? So capital structure is basically the pattern in which funds have been raised by the company, right? So we know that there are multiple sources of funds, right? We have got equity shares, we have debt, we have debentures, we have bank loans, we have preference shares, we have zero coupon bond, we have cash credit, overdraft, we have got different types of bonds also, GDR, ADR, all things is what we have covered. But now we are looking at a point where we are trying to identify what should be an ideal capital structure. We're trying to find out what should be the ideal capital structure. Like if I ask you, which capital is having the lowest cost? Which capital is having the lowest cost? Is it the equity or is it the debt? Is it the equity or is it the debt, guys? Which capital has got the lowest cost? Of course, it is debt, right? We have covered it in the last sessions of ours. We are saying that lowest cost is with the cost of debt. Now, why do we say that debt has got the lowest cost? Because compared to equity shareholders, debenture holders are generally taking lesser risk, right? They are taking lesser risk, and therefore their expectation, their requirement is also going to be lower. So from a company point of view, from where would you like to raise funds? Would you like to raise funds from the capital which is having the highest cost, or from the capital which is having the lowest cost? Where would you like to get the funds? From the capital which is having the highest cost or the lowest cost? of course, the lowest cost, right? But does that mean, since debt has got the lowest cost, does that mean that you should raise 100% funds from debt itself? So it's not possible. Not possible. So does that mean we can raise debt? We can get a company by fully debt, no equity, only debt, because debt is having the lowest cost. So let us run our company on the basis of only debt. Is it possible? No. You will not call that as a company, right? Because for being a company, you need share capital, right? So idea is, cost of capital is what we have computed, but that doesn't mean that we can always stick to the concept of lowest cost. So there are legal implications and other aspects also related to it. And therefore, what we would like to have a look at the multiple combination of capital. We would like to have a look at the combination of capital through which we can raise the funds. Some portion will have debt, some portion will have equity, right? Some portion we may have preference shares. So how to analyze that which capital structure is best for the company? Okay, so let's take an example to understand this. Okay, let's take an example to understand this. Okay, let's say we need a total fund of, suppose, 25 lakh. We require funding of how much? 25 lakh for our new business venture. So it's a startup. We want this 25 lakh as the fund. Now this 25 lakh, we are saying it will be, there are two possibilities or maybe three possibilities with us. So we are looking at like option 1, option 2, option 3. So three options. There are three options with us. So fund requirement is 25 lakh. Okay. Option 1, option 2, option 3. We have got the three options. Now, first thing to look at is raise it by way of equity shares, right? Or maybe by way of debentures, or maybe by way of debentures, or let's say preferences. So 25 lakh, first option we are saying, let us get this entire funds of 25 lakh by way of equity shares. Second option we say, equity shares, let's keep it as 15 lakh and raise 10 lakh by way of debentures. The third option that bankers are possible for us is to get 10 lakh equity shares and another 10 lakh, let's say debenture, and suppose 5 lakh of preference shares. So as per the legal requirement or as per the requirement of the standards, what we observe is these are the three possibilities. Okay, so of course, what's the total capital employed in each of these scenarios? Total capital employed everywhere it's the same, which is 25. Now tell me, will the sales number get impacted because I am raising the shares by way of equity or by way of debt or by way of preference shares? Are we going to have any impact on the sales? I mean, suppose if I raise by equity, will my sales figures be higher? And if I raise it by debt, the sales figures are going to be low. Is it going to be any time case? Is it going to be a case? Like suppose if you go to anywhere to have a food, let's say to a restaurant, right? So you're ordering something and do you ask the owner that is your business funded by equity or debt, and if the person says, no, I have got a lot of debt on my business, will you order 2 more dishes? Will you order 2 more dishes? No, right? You are not going to order 2 more dishes. So, of course, it doesn't happen that way, right? So, your sales is never going to be getting affected by the amount of debt that a company has, or the amount of equity that a company has, right? So, your sales is going to remain same. Then, Omkar, maybe out of mercy. Oh, come on. Are you going to have trouble in your stomach because you have got a lot of mercy? No, right? So your sales is going to remain constant. Okay, sales is going to remain constant. Are your operating expenses going to change due to debt? Like the cost of preparing the food, or the salary that you're paying to the chef, or salary that you're paying to the waiter? No. So all your expenses, basically your operating expenses, are not going to get impacted by these things. So your sales, variable expenses, your fixed expenses, which is operating fixed expenses, they are going to remain same, right? So what is going to be different? Up to EBIT, earnings before interest and tax, everything is going to remain same, irrespective of whichever plan you take. Whether you raise money by way of equity or debt, and equity, debt, or preference share, whichever way you raise the money, your EBIT is going to remain same. So let's say earnings before interest and tax, it is going to be 5 lakh. So your EBIT is 5 lakh. Okay. Yes, Sai Kiran Kumar.
Sir, here that other than equity share, for a debt and preference shares, we have to make repayment of the principal. Whether it matters in the calculation or not, sir?
It's not a prepayment of principal. Is it your expense? Repayment of principal and everything. Is it your expenditure?
But company resources have to be utilized for that, no, sir?
Company resources, you have to utilize it, but whatever you have received, you need to repay back. Because if you are getting debentures, you might have invested it in certain assets.
But in case of equity shares, that is not there. No, that is so advantageous, I'm telling.
That is advantage. But the moment you start earning less, equity shareholders will dump your shares in the market.
Okay, sir.
You lose your goodwill.
Okay.
You can make money, but you can make money, but you cannot, make respect later. So that's the big cost with equity shares.
But this point matters or not, I'm asking.
No. This point matters, but it's regard to repayment. Like I can definitely take another loan to repay the next loan, right? If I want to repay the debentures, I can take another bank loan, and the debenture can, debt can continue in my business. And the advantage is I'm taking the advantage of the less cost.
Okay, sir.
Okay. Okay, guys. So EBIT, earnings before interest and tax, is remaining same. Now, from here, the picture starts changing. Right? So from here, the picture starts changing, because up to EBIT, all the 3 plans are going to have the same outcome. But beyond EBIT, the numbers are going to differ. Because in option 1, are we going to have any interest? If we are going to raise money by way of equity, are we going to have any interest? Of course, no, because we don't have any interest. Now, suppose I need to assign some cost also. So let's say debentures are at the rate of 12%, or let's say debentures are at the rate of 10%. Preference shares are issued at the rate of 12%. And I hope you understand that preference shareholders will generally require higher return than debentures, because they are taking more risk as compared to debentures, right? So in case of first option, if you say into 10%, that is 0. Whereas in case of second and third option, we do have the amount of interest, right? Then profit before tax, will be EBIT minus interest, right? Then from that, we reduce further the tax. Now, let's assume the tax is 30%. So on this, we have into 0.3, which is 30% tax. Then we get a profit after tax. So profit after tax is PBT minus tax, which is 3,50,000, 2,80,000 and 2,80,000. Right? So PAT is remaining same. Of course, from that, we need to further reduce the preference dividend. Right? We need to reduce the preference dividend. So of course, in preference dividend, in option 1, there won't be any preference dividend because there is no preference shares issued. And we get preference dividend only in case of option 3. Then we have net profit for equity shareholders. That's 3,50,000, 2,80,000 and 2,20,000. So looking at this income statement, can you tell me which option should the company choose? 1, 2 or 3? Which option should the company choose? 1, 2 or 3? Option 1. Option 1. Congratulations, everyone. All of you are incorrect. You cannot decide only on the net profit for equity shareholders. We need to calculate the earnings per share because you're forgetting what is the ultimate objective of a finance manager. What is the ultimate objective of finance manager? Tell me, guys. Those who have been attending my class regularly, they will be able to answer it. What is the ultimate objective of finance manager? Increase the shareholders' wealth or wealth maximization. So, wealth maximization of all the shareholders, right? So, let us see what is the EPS that we are generating. So, let's say the number of shares, it was like 25 lakh. Let me divide it by 10, 10 being the face value. So, let us compute the EPS. Here it is 1.4, whereas in other cases, the EPS, you can observe that it's 1.87 and 2.20. So when do you think shareholders' wealth is going to increase? When you're providing them with greater amount of earnings per share. Am I right? Of course, if you increase the number of shares, the profit will also increase. But I don't want to do that. I want to see what is the earnings, which plan is giving me the maximum earnings on a per share basis. And which plan is really giving me the maximum earnings on a per share basis, guys? Option 3. Because there we have the EPS of 2.2. Again, here, if you know, or if the question gives you what is going to be the price earning ratio. We know price earning ratio? Price earning ratio, right? Do we know the price earning ratio? Yes. So price earning ratio is, what was price earning ratio indicating, by the way, guys? What was price earning ratio indicating? I know you are well aware of the formula. I'm talking of what was that indicating? Price earning ratio, what was that indicator for? Over or under price? No. How many times wealth? No. All of my dear Gajni people, price to earning ratio was indicating confidence of the shareholders. Higher the price to earning ratio, greater is the confidence of the shareholders. Right? If one company is having a price to earning ratio of 10, another company is having a price to earning of, let's say, 15. Right? So 15 is having a greater confidence. Right? So for 1 rupee earning, people are ready to pay 15 for that company because they have more confidence on that company as compared to the first one. Now in this case, option 1, 2, 3, where do you feel that P ratio will be high, or where do you feel that shareholders are going to have a higher degree of confidence? where do you feel that shareholders will have a greater degree of confidence on the company? In case of option 1, 2, or 3? Where are the shareholders going to have a greater degree of confidence? I'm not talking of profitability, guys. I'm not talking of profitability. I'm not talking of highest EPS. Where will you feel? Think you are a shareholder and tell me, where will you have a more degree of confidence? Where will you have a more degree of confidence that company will be able to do justice to your investment? Of course, option 1. In case of option 2 and 3, there is a risk involved in it, guys. There is a risk because company has taken a loan. And if company is not able to repay the loan or preference share, it may be wound up. But that's not going to be the case in case of option 1, because option 1, you have all the equity shareholders, right? So their greater confidence will be, of course, in option 1. So P ratio will also be higher for option 1. So let's say P ratio here it is 13, here it is 12, and here it is 11. Higher P ratio indicates higher confidence. Okay, everyone. Higher P ratio indicates higher confidence, and shareholders are going to have a greater degree of confidence in option 1. So now if I ask you, what is the market price per share? If I ask you what is the market price per share? 13 कहाँ से आया? 13 हवा से आया. जादू 13 जादू से आया. I am just saying that assume to be 13, 12 and 11. Got it? Yeah. So 13, 12 and 11 is what we observe generally in the market. And for similar companies, what is the P ratio? Now, so market price per share for first is 1.4 into 13. For next it is 22.44, and for the next one it is 24.2. So now think from the objective of the shareholders. Think from the objective of the shareholders. Where would the shareholders be interested? I mean, which plan would be preferred by the finance manager? 1, 2, or 3? Tell me, guys. Plan 1, 2, or 3. Where do you feel? From where should the company raise the funds? Of course, plan 3, because that is leading to maximum market price per share. Objective of finance manager, wealth maximization. Wealth maximization is possible only if the market price of the shares scale new highs. Right? Now, suppose I change this price to earning ratio and I say that here the price to earning ratio is 10. Now, what will be your decision? Which plan are you going to prefer? 1, 2, or 3? Now it is 2 because it leads to maximum share price. 22.4 maximum share price is possible in case of option 2, and that's not possible in case of option 3. Are we clear, guys? So the rule to choose a capital structure is to look for the market price per share. Whichever capital structure is giving you the highest market price per share, that will be chosen by you for investment, or that plan will be chosen by you to raise the money. Okay. Achha, what if there is no information about price to earning in the question, sir? What if there is no information about price to earning? Then you will make a decision on the basis of EPS. If there is no price to earning ratio given, then you will take the decision on the basis of earnings per share. Okay.
Sir, this higher PE ratio means growth is stagnated. Now, future growth prospect of share market prices is stagnated. Now, can we take like that?
No, high PE ratio means growth is expected. If people are ready to pay more money for your company shares, it means they are expecting some future returns.
Okay.
Okay. Lower EPS, better wealth, Pranav? No. I'm talking of market price per share. Market price per share higher is indicating better wealth or higher wealth. High PE ratio is only possible if company is bootstrapped, sir. Am I correct? No, don't talk about bootstrapping right now. Bootstrapping is a separate thing altogether. Don't bring such high funda words right now. Okay, we are just in the very initial phase. Maybe 4 or 5 sessions of FM. Don't assume yourself to be Rakesh Jhunjhunwala or Warren Buffett. Okay. There are a lot of things to learn. Just by attending 4 or 5 sessions of FM, you can't beat the fund managers who are taking crores or maybe hundreds of crores of salary. Right? It's quite logical. So wherever we observe that highest market price is possible, that plan is going to be chosen for getting the funds into the business. Okay, guys. Fine. So today's session, our earnings you calculated. These all are assumed figures. Okay, these all are assumed figures. So just relax. So EBIT was an assumed figure. Capital structure, all assumed figures. I just wanted to explain you that market price per share is going to play a role when you're going to take a call regarding the capital structure. Okay, now let's go for a question to understand it or to make it more intuitive. So we'll do a couple of questions, then post that we'll take a break, then we'll do some concepts and then questions based on that. So let's come to this question number 2, guys. Question number 2. Okay. Srini has completed CFA level 2. When did you clear, Srini? CFA level 2. Question number 2, guys, you can just take a read. Long back in 2009. Oh, so that's finance domain has taken a steep degree of change since 2009. A lot of new products have come up. Anyways, coming back to question number 2, guys. The existing capital structure of XYZ is as under: equity shares of rupees 100 each, 40 lakh, retained earnings of 10 lakh, 9% preference shares of 25 lakh, 7% debentures of 25 lakh. So existing capital structure comprised of these numbers. Okay, so what's the total capital employed right now? Total capital employed by the company right now. What's the total capital employed? Current capital employed of the business? 1 crore, right? So let's write down the capital. Then current, and I think there are 3 different plans. So plan 1, let me take plan 1, plan 2, and plan 3. So I've got 3 different plans along with the current plan. So current capital structure comprised of equity share capital of 40 lakhs. So we have like equity share capital of 40 lakhs. Then we have retained earnings. Retained earnings are 10 lakh. Then 9% preference shares. Preference shares of 25 lakh. Then 7% debentures of again 25 lakh. This is what the existing capital structure of the company is. The existing rate of return on company's capital is 12%. So it means company is into such a business which gives 12% as return on capital employed. So existing rate of return on company's capital is 12%. So you get a rate of return as 12% and income tax rate is 50%. Company is in need of additional 25 lakhs to finance its expansion program. So to support our expansion program, we need 25 lakhs for which it is considering the following alternatives. So three options we have. First one is getting it by way of equity shares, and they're going to issue it at a premium of 25 per share. Now tell me, what will be the issue price of each of the shares in the first case? In first case, what will be the issue price of each share? Issue price of each share. How much is it going to be? Can I say 100 rupee? On that, we have a premium of 25. So 125 will be the issue price. So 20,000 shares at a price of 125. Does it translate to the requirement of 25 lakh? Just check. 20,000 shares into 125 each. Does it match? Yes, it matches. Then second option is issuing 10% preference shares. Of course, face value itself will be 25 lakhs. And debentures also will be for the same amount. Now, plan one is to get it by way of equity. So, can you tell me what will be the amount of equity shares that will be issued? The number of shares that we will have. I mean, share capital will be how much, and accordingly the number of shares is going to change. So of course this is going to be 40 lakh plus we are raising like 20,000 issues, right? We are issuing 20,000 shares, and that will be multiplied by 20,000 shares multiplied by 100, right? Because face value is that much, right? So you can say it is 40 lakhs plus 100 into 20,000. Correct? Yeah. Now, what will happen? Of course, we have got this as thing. Now, 100 is what we have considered. What about the 25 rupees? Yes, originally it was reserves were originally 10 lakh. To that, can I say we are going to add 25 rupees multiplied by 20,000. into 20,000. So what will be the new reserves? Original 10 lakh plus 25 into 20,000. So 15 lakh will be the amount of retained earnings. And of course, the older preference shares and debentures will continue. What about the second plan? What about the second plan? Second plan is by way of preference shares. So of course, the equity shares, retained earnings are going to remain same. 9% preference shares. Instead of 9% preference shares, we have like 10% preference shares. Right, so 10% preference shares. The new set of preference shares are going to be added over here. Older ones are going to continue. 10% preference shares of 25 lakh coming in plan 2. And then in plan 3, we have the same amount of equity, retained earnings, preference shares, and also the debentures. But a new category of debentures will be issued at a cost of 8%. So we can say it is 8% debentures. Okay. Now, this entire thing, let me just make it comma style a bit better way. Yeah, so total capital employed, currently we know it is 1 crore, but going ahead in plan 1, it's 1 crore 25 lakh, right? So total capital employed is 1 crore and 1 crore 25 lakh in the other 3 years. Yes. Is this capital structure format or this preparation of this capital structure, is it clear, everyone? Yes. Okay. Let me just reduce the font size of it so that I can fit it into smaller areas. Then, yeah, this looks more tidy. So total capital employed is 1 crore, 1 crore 25 in each of the cases. Now, based on total capital employed, is what we have computed. Now we have to make a plan, make a choice of each of these 3 plans. Which one of them is really going to be beneficial for us? So for that, the company requires this 25 lakh to invest. It's estimated that price earning ratio in case of equity preference and debenture would be 20, 17 and 60. And which of the alternatives would you recommend, and give reasons for choice? Now, when we were earlier into 1 crore capital employed, right? When we were having 1 crore capital employed, we definitely had some return that was generated. So what was the return on capital employed? Return on capital employed was 12%, right? Now, what would you expect when the company is bringing in additional 25 lakhs and investing into the business? Can I say return on capital employed will continue to remain same 12 lakh? Am I right? Return on capital employed will continue to remain same 12 lakh. So based on return on capital employed, can you tell me what will be the EBIT? Based on return on capital employed, can you tell me what is the EBIT? Earlier, we were having an EBIT of 12%, but now in the subsequent years, subsequent plans, we're going to have an EBIT of 15 lakh. Now, can you take this question forward and calculate like less interest, then you get PBT, from that you subtract tax, then you get PAT, from that you subtract the preference dividend, and then we get the net profit for equity shareholders. Of course, we divide this by number of equity shares to arrive at EPS. Can you complete this income statement fully? Of course, P is also given to us, based on which you have to get the market price per share. Can you compute this fully and give me the market price of all the 4 situations? Like currently, what is the market price, and what is the market price that we are looking if we are going for plan 1, 2, or 3? Can we do that? Okay, so try to do it within next Okay. Now audible? Yeah. Reach up to market price per share, guys. Now, since I'm putting up the question in front of you, try to get up to the market price per share. Okay. What does plan 1, 2 signify? Plan 1, 2, 3 doesn't signify anything. Yeah, that's the three plans or three ways, three options to raise money for the business. Okay, let me complete it. So interest will be 7% debentures into 7% plus 8% debentures into 8%. Yeah. So just check, are these your interest numbers? Then from EBIT, you subtract the interest to arrive at profit before tax. Then tax is simply 50%. PBT into 50%. Right? Then the PAT figure will be PBT minus tax. Then preference dividend will be 9% preference shares into 9% plus 10% preference shares into 10%. These are our preference dividend. Net profit for equity shareholders will be computed on a similar lines. Number of equity shares is simply going to be the number in the share capital divided by 100. Okay. So EPS will be net profit for equity shareholders divided by number of equity shares. This is the EPS. Now, of course, the question is also giving us a P ratio. P is 20, 17, and 16. 20, 17, and 16. Do we have the P ratio currently? No. Current P ratio is not given to us, but we can assume to be remaining same. 7.19 into 20. Same way others. What do we observe? Where do we find that the share price is highest? Where do we find which plan is actually giving us the highest share price? Of course, it is plan Y, plan A or option 1, right? First option, plan 1 is giving us the highest share price, and going by the wealth maximization objective of the shareholder, of the finance manager, the finance manager should raise money by way of plan 1 only. Is this clear, everyone? What are the interest components? Interest components will be just the debenture amount multiplied by the rate of interest. Yeah.
Hi, sir. Good evening.
Yes, I. Yeah.
In this scenario, if we see as we are taking decisions based on the market price share.
Correct.
But market, we know that in the listed companies, there is a huge fluctuation due to various reasons in the market price, not only on their financial performance, other aspects such as.
No, but we are considering the ideal PE ratio. It's not the some temporary shift in the market price due to demand and supply.
So we are taking an average or something fair price.
Yes. So ideal PE ratio is what we are considering.
And then my next question was here the security premium reduces the amount of equity shares, number of equity shares we will be issuing, right, sir? That impact has huge impact.
It's already been accounted because we are issuing 20,000 shares for issuing 25 lakh amount. The retained earnings has been already been impacted with the securities premium.
So that's why I'm asking clarification that that if there was no securities premium, we would be issuing more shares.
Then
right?
fully it will be coming in the equity share.
Okay, thank you.
Okay. Yes.
Sir, in plan 3, EPS is on the higher side, na?
Plan 3, EPS is on the higher side. Okay.
But that is not a matter.
No, that won't be accepted because our objective is wealth maximization.
Market price only matters.
Yes, market price matters because market price is indication of the shareholders' wealth due to the company.
Okay, sir.
Okay. Fine, guys. So this is the simple question that we had. Now let's take up another question on the similar lines. Question number 3. Question number 3. So it says how to compute P ratio. P ratio will be given to you, Sanatana. P ratio will be given to you. Or if you want to compute, you can compute simply a comparable company market price per share divided by the earnings per share of a comparable company. Please explain equity issued at a premium. So equity shares were issued at a premium of 25 each because share issue price this case was 25, premium of 25. So 100 rupees face value. Equity shares of rupees 100 each face value. On that 25 is a premium. So each share is being issued at a price of 125. So that 25 rupees premium goes into securities premium, 100 goes into the share capital account. Okay. Sure. Now, look at question number 3, guys. Profit has been given as 2,60,000. Interest on debentures at 12% is 60,000. So, what sort of profit is this? 2,60,000. I say this 2,60,000 is your EBIT, right? So current EBIT is 2,60,000. Currently, we are also paying interest on debentures at 12%. So this is PBT. Then we have PAT, profit after tax is given, number of equity shares, EPS, ruling price in the market is given, and P ratio is given. The company is having an undistributed reserves of 6 lakh. The company needs 2 lakh for expansion. This amount will earn at the same rate as funds already employed. You are informed that a debt equity ratio, which is debt upon debt plus equity, higher than 35%. The debt equity ratio higher than 35% will push the P ratio down to 8 and raise the interest rate on additional amount borrowed to 14%. You're required to ascertain the probable price of the share if additional funds are raised by way of debt and if the amount is raised by way of equity. So initially, we need to get the current capital that we have. So in the current capital, can you tell me from the given information what all things are included? What all capital is the company having? Of course, equity share capital is there, reserves is there. Apart from that, is the company having debt? Is the company having debt? Yes, because that 60,000 interest you're paying. So of course you have debenture. Current capital, you can say equity share capital. Then we have the reserves, and then we have debenture at the rate of 12%. Okay. What will be the current capital, equity share capital? Because it is 40,000 shares at a price of rupees 10 each. That will be 4 lakh. Reserves. What is the amount of reserves? That's given already 6 lakhs. Right? Debentures. What are the debentures? Debentures at 12%, 60,000. So can I say it will be 60,000 divided by 12%? So 5 lakh is the debenture. So existing capital is actually 15 lakh. Correct, guys? Existing capital is 15 lakh. What is the additional funds? What is the amount of additional fund that we need? Amount of additional fund that we need. The company needs 2 lakh more for expansion. Company is in need of 2 lakh for expansion purpose. So if it is for 2 lakh, there are two options, either to issue equity or to issue debt. Now, what will be the price at which you will be issuing equity shares? What will be the price at which you will be issuing equity shares? Price at which you will be issuing equity shares. See, current market price is 25. So will you issue equity shares at a price less than 25 or at 25? Of course, at 25. Correct? So we'll be issuing the equity shares at a price of 25 itself. Correct? So equity share capital, we'll be issuing it at a price of 25. So can you tell me what will be the amount of equity share capital in plan 1? Because in plan 1, we are issuing this, can I say 4 lakh plus how many shares do we need to issue? Because to get 2 lakh rupees, what will be the number of shares to be issued? Number of equity shares issued for 2 lakhs. क्या होगा? Number of equity shares to be issued for 2 lakhs. Can I say it will be 2 lakh divided by 25 each. So of course the share price becomes 8,000. The number of shares is 8,000. So can I say this is going to be 8,000 multiplied by 10. Same thing over here. This is going to be 8,000 multiplied by 15 because 15 is going to go to the reserves. So 4 lakh plus 8,000 into 10. And here it is 6 lakh plus 8,000 into 15. Of course, the debenture continues. So now the total capital employed will be 17 lakhs. Problem coming in. Oh. Oh. Okay. So this is 17 lakh. Now the second plan will be obviously involving new debt. So equity share capital will remain same, reserves will remain same, debentures will remain same, but a new debt of 2 lakh will be issued, and of course the total capital over here is also going to be 17 lakh. Okay. So now we have 15 lakh, 17 lakh, 17 lakh as the plan 1 and plan 2 requires capital total capital employed of 17 lakhs. Okay, now in this case, in case of plan 2, there is something a catch in this question. And the catch in the question is it says that the amount will earn the same rate as the funds already employed. That is okay. Okay. Debentures 5 lakh is given. Interest is given, na Apur? Interest 60,000 divided by 12%. Okay. So we are going to say that whatever existing income you have, whatever existing return on capital employed you have, same you are going to get even in the new fund. That's okay. But then the point is you're required to you're informed that debt equity ratio. Now debt equity ratio over here is debt upon debt plus equity. So debt upon total capital. They've clearly specified this is to be done. Higher than 35% will push the P ratio down to 8% and raise the interest rate on additional amount borrowed to 14%. We need to first compute over here debt upon debt plus equity. So in this case, we have like debt of 5 lakh upon debt plus equity is 17 lakh. In the first case, it is 0.29, whereas in the second case, that is 5 lakh plus 2 lakh. So now, if you observe the proportion, this one, 41.18, can I say it is exceeding the 35% threshold limit? 41.18, can I say it is exceeding the 35% threshold limit? So this is greater than 35%. What will be the implication for this? Price to earning. How much will be the price to earning? Existing PE is 10. And if you're going to issue equity shares, price to earnings will be also remaining same 10. But what about this company? Like, what about the second plan? What are the second plan? Can I say now the P ratio will be 8? And what will be the cost of new debt? Cost of new debt will be 14%. Correct? And what is the return on capital employed, by the way? Because I need to have the same return on capital employed for all the 3 plans. What's the return on capital employed? Because we have a EBIT of 2,60,000. So here the return on capital employed was 2,60,000 divided by 15 lakhs. So I'll say this is 2.6 lakh divided by 15 lakhs. So this is 2,60,000 divided by 15 lakh, which is 17.33%. Can I say this same 17.33% will be applicable even to the other two plans? Because the question has stated that EVA return on capital employed will remain same. So based on that, we can definitely say that earlier our EBIT was this. Now over here, the new EBIT will be 17.33% of 17 lakh. Right? So EBIT is remaining same. From this, we can reduce the interest. Interest will be the amount of debenture multiplied by 12%, plus if you are issuing any new debenture, that is going to cost 14%. So you'll have a higher amount of interest in the third plan. We'll get this as profit before tax, which is to subtract the interest. This is what we have as a profit before tax. From this, further we are going to reduce the tax. So tax will be PBT multiplied by, what's the tax rate given? 50%. Then we get profit after tax of 20 lakh minus 10 lakh. Right? Now, of course, we need the number of equity shares. Number of equity shares will be the equity share capital divided by 10. Right? So we have 48,000 and 40,000. And then what's the earnings per share? Earnings per share will be PAT divided by number of equity shares. Right? Finally, P ratio is what we have already written, 10, 10 and 8. Right? Then finally, what will be the market price per share for each of the plans? 25, 24.4 and 20.67. What should be your call? What should we really do? The return on capital employed was 17.33%. But when we are issuing additional shares, we are observing that it is leading to erosion in the market price of the share. So should the company take up this project? Should the company raise this additional 2 lakh and try to get new business for it? No, because it will lead to reduction in the market price. Correct, guys? Yeah, so this is what we have this question. Now we'll take a break. Okay, but before break, let me see what is. Yes.
Sir, that EBIT calculation 234, 667, 206, 667, how it came? Can you tell me?
234.
How it came, please?
It is the return on capital employed multiplied by capital employed.
Please show, sir. Here you will note down, sir. Please show here.
Yeah. It's stated a return on capital employed. So EBIT will be, of course, return on capital employed multiplied by total capital employed. Because you know what's the rate of return earned? That rate of return multiplied by the total capital employed will give you the EBIT.
Okay, sir.
Yes, Rachna.
Sir, even I had the same doubt. You're saying 15 lakh into 17.33%.
Yeah.
But we're not getting 2,60,000 on that.
You will get 2,60,000. Take 17.33333 complete.
Okay. Yeah.
Okay, so that's a rounding up error, nothing big.
Yeah, so we get 25,99995 something.
So anyways, 2,60,000 is given in the question.
Okay, sir.
Okay. How do you know P ratio is 10? It's given in the question, Tanatan. P ratio 10. Okay. So let's take a break, guys. A break of 10 minutes. And then we will continue with some more concepts. Okay. So let's take a break, guys. Yeah.
Sir, here remaining all the calculations we are doing actuals only, but market price is a presumption only, sir. Assumption only, sir.
Market price is based on PE ratio, price to earning ratio.
But that is the assumption only, sir. That
is given in the question.
Okay, but I am asking, it may be based on the assumption only, sir.
Yeah.
But in future, our market price will be there. We cannot presume. Now, remaining all we can presume, but this we cannot presume, sir. That I must.
Yes. The PE ratio of a comparable entity is given.
Okay. That is assumption only. Okay, sir.
Yeah. Interest over here. This is the old 5 lakh into 12%, and the new debt is at a cost of 14%. Got it? PE is 10, given 8. How have you written 8? Read the question carefully. Debt equity ratio higher than 35% will push the PE down to 8 and raise the rate of interest to 14. If your P ratio, if your debt equity ratio is greater than 35%, P will become 8 and cost of new equity will be 14%. Okay. Interest rate of 88,000. ये तो पता है. 5 lakh into 12% plus this 2 lakh extra debt at a cost of 14%. Got it? Yeah. Ambeshwari. You get it? Original 60,000 plus 2 lakh new debt. On that you have 14% interest. Okay, fine. Let's go for a new concept now. Okay. We're going to learn something called as financial break-even point. Do we know what is a break-even point? Okay. Tell me what's a break-even point? What is break-even point? Where there is no profit, no loss. You're not telling me what is break-even point. You're telling me what happens at break-even point. I'm asking you what is break-even point. You all guys are answering me what happens at break-even point. I know that at break-even point there is no profit, no loss. But what is that break-even point? I'm getting answered. The point at which no. What is that break-even point, Baba? Break-even point is the level of sales at which there is no profit and no loss. Okay, so break-even point is that level of sales at which there is no profit, no loss. Now all other things follow over there, that your sales equal to expenses, or your fixed cost equal to contribution. So all those things are the things that happen at break-even point. But what is a break-even point? Break-even point is the level of sales at which there is no profit, no loss. Okay, so just don't blindly say always that break-even point means no profit, no loss. It's very premature to answer this. Okay, so you should be saying always what is the break-even point is that level of sales at which the company earns zero profit or zero loss. Okay, now we have to learn something called as financial break-even point. Now we know financial break-even point essentially starts from the EBIT. I mean, the financial statement with regards to financing part starts with the EBIT. So we'll say it is level of EBIT at which EPS is equal to 0. Okay, so financial break-even point is that level of EBIT at which EPS is 0. Okay, so let us say EBIT as of now, suppose it is 1 lakh. Okay. Now, of course, from that we subtract the interest. So interest is 20,000. We get profit before tax of 80,000. Then we subtract the tax. Tax is, let's say, 50%. Then we get a profit after tax of 40,000, right? Then we subtract the preference dividend. Preference dividend is, let's say, 30,000. So net profit for equity shareholders is coming out to be 10,000. Okay. So can I say that this EBIT, is it a financial break-even point? Is 1 lakh your financial break-even point over here? No, because we have a net profit as a positive figure, right? We have a net profit as a positive figure of 10 lakh. So EBIT is like 1 lakh, but the net profit for equity shareholders is 10,000. Suppose this is not a financial break-even point. So if I want to say what is the financial break-even point, I need to find out that EBIT at which this net profit for equity shareholders will become 0. So what should I do with this EBIT number? Should I increase it or decrease it? If I want to know what is the EBIT number, should I increase it or decrease it? Decrease it, right? So let us say, let me make it as 90,000. Still we have this 5,000 available. Now let's say, suppose this is 80,000. Now we have, yes, net profit for equity shareholders to be 0. So can I say this 80,000 is what we mean by financial break-even point, right? Now, how do we really calculate the financial break-even point number? We cannot do this trial and error every time, right? So we'll have to calculate we'll have to obtain a formula for financial break-even point. Let me just give a hint to you. How do we go about it? Now, of course, preference dividend will be just PD. Interest will be represented by interest itself. Okay. Now, let me assume, let financial break-even point be rupees X. Let the financial break-even point be rupees X. If the financial break-even point is rupees X, EBIT will take it as X, right? Now, EBIT, if I am taking that as financial break-even point to be X, X minus interest, what will be coming over here? PBT. What will be the profit before tax over here? What will be the profit before tax? Can I say it will be X minus interest? Now, how do we get the tax? Can I say tax will be X minus interest multiplied with the tax rate. Correct? So PBT is X minus interest. X minus interest multiplied with the tax rate is this. Now what will be the PAT? Can I say PAT will be X minus interest, the whole multiplied by 1 minus T. Correct? Because X minus interest minus X minus interest into T. Your X minus interest goes common outside, and then you have X minus interest into 1 minus T. So now we have preference dividend. The net profit for equity shareholder will be X minus interest multiplied by 1 minus T minus preference dividend. X minus interest multiplied by 1 minus T minus preference dividend. Right? And tell me what should be this number equal to? Like if I'm saying that X is the financial break-even point, so what should be this number equal to? This number should be equal to how much? 0, right? Should be equal to 0. So if we just try to solve this and try to get the value of X, then it will be X minus interest, the whole multiplied by 1 minus T will be equal to preference dividend. And then we say that it is X minus interest will be equal to, can I say, preference dividend divided by 1 minus T. So what will be this X equal to? X will be equal to what? Preference dividend, or I can say it is interest plus preference dividend divided by 1 minus T. Correct? So this is what is the formula for financial break-even point. So we can say financial break-even point is equal to interest plus preference divided upon 1 minus T. You can just verify it over here. Let's try to verify it here. Interest. What was the interest in this case? What was the interest in this case? Can I say 20,000? This was 20,000 plus a preference dividend of 30,000. Sorry, yeah, 30,000 divided by 1 minus 0.5. You can observe this is coming out to be 20,000 plus 30,000 divided by 0.5. Answer is same 80,000 as what we have got even by trial and error. Right, guys? So financial break-even point is 80,000, and the formula is simple. What's the formula for financial break-even point? It is interest plus preference dividend upon 1 minus T. Interest plus preference dividend upon 1 minus T. Got it, everyone? Yeah. Yeah, Bhavna. You have anything to say?
Hello.
Yeah, Anirudh.
So could you please repeat how the preference dividend upon 1 minus T was derived?
This is X minus interest into 1 minus T equal to preference dividend. So this 1 minus T will go to the denominator.
Okay, got it.
Good evening, sir.
Yeah, good evening.
Sir, here EBIT is called the financial break-even point.
EBIT?
Is called financial break-even point.
No, not all EBIT is financial break-even point. EBI, that EBIT at which your EPS is resulting it to be 0, that is called as break-even. That is called as financial break-even point.
Sir, here you take EBIT and financial break-even point both X.
No, I said financial break-even point be rupees X. And what is financial break-even point? It is that EBIT at which your EPS is becoming 0. EBIT can be anything, but which EBIT is your break-even point? Where the EPS or net profit is becoming 0.
Okay. Okay, sir.
Okay.
Thank you.
Sir, sir, actually, why should we compute the financial break-even point? Because the objective of the finance manager is to maximize the wealth of the shareholder.
How do you maximize
So why
the
are
wealth?
why are we taking it as 0?
Have I told yet the implication of this? No, I haven't. So hold on.
Okay, sir. Thank you.
Hello, sir.
Yeah, Shinu.
Sir, in that finance break-even point, we have included interest and preference dividend, right?
Yeah.
So it's basically debt and preference, right?
It is a
debt capital and preference capital, right?
Yeah.
So why not we included the equity also in that? Because
on equity, you don't have any obligation to pay fixed. There is no obligation on you to pay any fixed amount of interest or preference dividend in case of equity. So there's no obligation, and therefore, if in the absence of any fixed cost, how do you determine what will be their amount to be paid to them?
Okay. Okay, sir. Yeah. Thank you.
Okay. How 1 in 1 minus t came? You take x minus t common from this. Gerald? Yeah. Okay. So financial break-even point is 80,000 over here. Now, the company is having multiple financing plans to choose. Answer comes to 1 lakh. How come? 20,000 plus 30,000 divided by 0.5. 0.5 is only divided by 30,000, not the entire thing. Okay. Yeah. So we have got financial break-even point here to be 80,000. Now, what is the use basically of calculating this financial break-even point, right? Do you agree that each of the plans will have different financial break-even point? Each of the 3 plans will have different financial break-even points, yes or no? You have multiple, like, each plan will have different amount of interest, and each plan will have different amount of preference dividends. Of course, each plan is going to have a different financial break-even point. Now, if we have, let us say, 3 plans, okay? Plan 1, plan 2, and plan 3. Have equity share capital, debenture, and preference share capital. Okay. Now, for each of these 3 plans, if we look at, let us say equity share capital, 10,000. Here it is 7,000. Okay. Debt is, let's say, 3,000. Financing plan is having a, just let's say 5,000. 1,500 debt, 1,500 equity. Let's say debt is at the cost of 10%. Preference share capital is at the cost of 12%. Now, each of these plans are definitely going to have different break-even point, financial break-even point. Right. So before we compute the financial break-even point, let's talk of what is the amount of interest and what is the amount of preference dividend? In the first case, can I say no interest, no preference dividend in the first plan? Correct? What about the second plan? Second plan will have a interest of 3,000 into 10%, and of course there is no preference dividend as such. Second plan, I mean the third one, it has a interest of 250 and preference dividend of 300. So financial break-even point, applying the formula, can I say interest plus preference dividend divided by 1 minus, let's say 50% is the tax rate. We assume tax rate as 50%. The first case financial break-even point is 0. In the second case, it is interest plus 0 upon 1 minus t, and this is of course 250 plus preference dividend divided by 1 minus t. Yeah, did we get this financial break-even points, everyone? Did we get the financial break-even point, everyone? Using the formula, it's like 250 plus 300 divided by 0.5. And this is just the interest, correct? Now, so in which of these three plans do you think? In which of these three plans do you think, company will require a higher level of EBIT to start making profits? In which of these three plans do you feel the company will have to put more efforts to generate more EBIT so that it can become profitable? Or if I ask you simply, where is it easy to be a profitable company? Each of these three plans, where is it easy to become a profitable company? Can I say plan 1? It is easy to become a profitable company in plan 1 because your break-even point is 0. So whatever you earn, you start making profits. You don't have to pay any finance expense. But in case of plan 2 and plan 3, what do you observe? In case of plan 2 and plan 3, can I say this plan 2 means at least 300 EBIT is required. Plan 3 states at least we need a EBIT level of 300, and plan 3 is stating that we need at least EBIT of 850 to start making profits. Now let me just demonstrate it to you how these things really work out. So we'll take a range of EBIT and we'll say what is EPS in case of first plan, then what is EPS in case of second plan, and what is the EPS in case of third plan. Okay, and then I'll show you how is this really going to work. So let's say if your EBIT is 0, then you can take suppose EBIT of 1000, then maybe you can take a EBIT of 2000, like 500 EBIT, 1000 EBIT, right? And then 2000, then we have 4,000, 5,000 and 10,000, right? Can we compute the EPS over here? What will be the EPS if your EBIT is 0, guys? Tell me. What will be your EPS if your EBIT is 0? Now let me just give you a simple idea. How do we really compute the EPS figure? See, we start with EBIT. Now from EBIT, we are going to subtract the interest, correct? We make EBIT minus interest. Now we can make this after tax by simply multiplying it with 1 minus t. We simply multiply it with 1 minus t to arrive at the after tax figure of thing which is PBT. Can I say from that we subtract the preference dividend and then we divide it by number of equity shares, correct? This is your EBIT. When you do EBIT minus interest, what is this indicating? when you do EBIT minus interest, what is that number? EBIT minus interest. Profit before tax, right? Now, profit before tax, when you multiply it with 1 minus T, what does this become? It becomes PAT. And then when I subtract preference dividend from that, can I say we are getting the net profit for equity shareholders, and then we divide it by number of equity shares? Correct, guys? Is this formula of EPS clear to you? Yes? Okay. Now, we know the number of equity shares in each of these cases. Like in first case, number of equity shares is, let's say, 1000. And in the other cases, it is 700 and 500. Can you calculate the EPS quickly for this? Like suppose if your EBIT is 0, what will be the EPS figures? This? Yeah. If EBIT is 0, EBIT is 0, what will be the EPS for all the three plans? Can you tell me what will be the EPS for all three plans? Tell me the EPS for all the three plans. The first plan, EPS will be 0. Correct? Or what about EPS for the second and the third plan? For the second and the third plan, what will be the EPS? Can I say for the second plan, sir, EPS, EBIT is 0. So on that, we subtract interest. Subtract the interest. To that, we multiply 1 minus tax rate of, let's say, 0.5 minus the preference dividend. And then this whole thing is going to be divided by the number of equity shares. Can I say on a per share basis, we're getting this as minus 0.21. Right? So we are in the negative zone. Now, same way, if I want to compute for EPS for plan 3, can you tell me what will be the EPS if your EBIT is 0? So EBIT is 0. Can you tell me what is the number for this? Yeah. It is minus 0.85, right? Because it is simply 0 minus interest payment of 250 into 1 minus T minus a preference dividend payment of 300, and then you divide it by 500. So is it minus 0.85, everyone? Yes.
Sir. Good evening, sir.
Good evening.
Sir, नेगेटिव वैल्यू पे तो टैक्स लगता ही नहीं.
टैक्स सेविंग होगा बेटा, ये अज्यूम कर रहे हैं. दूसरे बिजनेस में टैक्स सेव होगा.
अच्छा, मतलब सेट ऑफ कर रहा हूँ.
सेट ऑफ कर लेंगे हम.
ठीक है सर.
Same question, sir. That 300 minus 300 by 700, I thought, sir.
Minus 300 by 700.
Yes, sir. That tax will not be there now for 300.
Tax, we are assuming there are other businesses from where you can claim the tax benefit. You can set off the losses against the other businesses.
Yes, sir. In that EPS formula, why can I say that any amount higher than my financial EBIT into 1 minus T is equal to divided by number of shares is equal to EPS per share.
Any
Can I
amount?
repeat? Any amount greater than my financial EBIT.
Financial EBIT. What is financial EBIT?
That means EBIT at which my financial financial break-even EBIT is.
Any amount greater than financial break-even point will lead to profit.
That only, sir, I am referring to.
Yes,
Into
yes.
1 minus T divided by number of equity shares would be EPS formula, right, sir?
Yes, yes, yes.
Sir, sir, by chance, same question comes in the exam. So, sir, we will take this assumption that we have assumed that there are other businesses, so we have to set off the risk.
This is not what is exam. I'm just trying to show you something. I'm just trying to show you something in the form of a graph, and for that I'm just doing. Okay.
Okay, sir. Otherwise, question will mention it properly.
Yes.
Okay, sir. Thank you, sir.
Okay. Fine. Okay, so EPS numbers, by applying this formula, we get this. Now, if it is 200, we will find the EPS numbers are this. If it is one more thing I take. If it is 300, you will find these are the numbers. Now for 500, for 850, for 10,000, you can observe that this is what the EPS is going to be, right? So for EPS, what we observe is EPS is obviously going to rise. EPS is definitely going to rise with the rise in the EBIT. Can you observe that? Can you observe that as the EBIT increases, the EPS numbers are definitely going to rise? And are you able to see the influence of the financial break-even point over here? See, one is over here, then 300 otherwise, and then 850. We have the financial break-even point. Are you able to see this? Yes. 0.1 for 200. Why? 200 divided by this. So are we able to see the financial break-even point working over here? See the EPS turning out to be 0. Now, if I ask you, out of this plan, where do you become profitable early? Where do you become profitable early? In plan 1. And can I say you become profitable early in plan 1, of course. But then, if you look at, larger values for EBIT, you will observe that as you reach up to EBIT of 10,000, your EPS of plan 1 is, always in that higher position. Correct? So you become profitable early in plan 1. Now, if I ask you which of these two plans or which of these three plans are, less risky, of these three plans, if I ask you which of these three plans are less risky, which plan are you going to say? Which plan are you going to say that it is less risky? Of course, plan 1. Why do you say that plan 1 is less risky? Because you start making profit very early. You start making profit very early, right? For example, if I ask you another simple question, you want to start your food business. Yeah, I have not deducted tax. This is EBIT. Oh yeah, just taken the EBIT, right? Yeah, there's a change. I need to multiply it with 0.5, right, guys? Just taken the EBIT. That should not be the case. I need to multiply it with tax also, correct? Yes. Now it is okay. Yeah. I was asking you, let's say you want to enter into food business, right? So if you want to start your food business, let's say you want to sell to your customers, and you have two choices. Either to start from a very roadside eatery, right? Like a food truck or something on a roadside eatery. Experiment the product that you have with you, and try to gauge whether the buyers are really liking your product or not, and then go for slowly and steadily greater expansion. Or you go for straight away opening up a big restaurant. Where do you feel you have got a high risk, or where do you feel that you will start making profit early? Where do you feel that you will start making profit early? Roadside one, right? Second one is risky, right? You open up a big swanky restaurant and you have like a seating capacity of 50 customers, and you have hired a chef, you have hired the waiters, you hired a cashier, you're paying rent. So then your fixed cost is really high. Now that fixed cost is it's going to influence in a way that the fixed cost will be very difficult for you to recover, because you see in plan 2 you need a bare minimum EBIT of 300 to recover your fixed cost of 300. Now in plan 3, to recover your fixed cost, you need a EBIT of 850. You need a EBIT of 850 to recover the cost. So it is difficult for you. It's going to be not I cannot say difficult, but it's not easy for you to become profitable in plan 3 as compared to plan 1. Am I right, guys? It's easy to become profitable in a roadside eatery than in case of a restaurant. Because even if you're having good sales at your restaurant, it should be not good sales, it should be excellent level of sales, so that you will be able to meet your fixed expenses. Because unless you are able to recover your fixed expenses, you are actually not doing good business, right? So of course, now if I ask you, where do you have a potential to earn huge profits? A roadside eatery or a restaurant? Where do you have a potential to earn huge profits? Of course, a restaurant. It's easy to open a roadside eatery, but you cannot, you cannot earn very high amount of profits from a roadside eatery, because you will be constrained to that, space of maybe 50 square feet, and you will be having a limited staff. Your capacity to serve the customers will be also limited, right? You may make maybe maximum you can serve around 5 or 10 customers, right? So that is something, where you say roadside eatery has got a very less potential to, expand at a larger scale. But you have a greater potential in case of a restaurant. Now, don't give me the example of that Delhi girl, Delhi Vada Pav girl, right? Some of you may say that, see, that girl has actually become famous by selling, food on roadside. And it's like that girl has become really famous by selling food. So roadside eatery has got a big amount of fan following, and you can expand your business. But understand, she's not expanding her business. She's expanding herself, rather, I can say. She's selling herself. She's not, selling the goods to, expand the business. That's a popularity, or that's a PR thing that's happening. So that you cannot bring it over here. Same way you cannot bring our Dolly Chaiwala to this case. Okay, she's a roadside eatery, and having so much of fan following. But again, those are exception items. They are not actually expanding business they are actually expanding by way of publicity, right? So they are not selling food; they are selling some sort of content, right? So they are not into the product service; they are into marketing of their own style or their own way of Rona Dhona or maybe some sort of styling, whatever, all those things. So that we are not considering those aspects. Okay. So we are saying here that it's easy for us to set up a roadside eatery, but then there's a limitation that you cannot grow at a faster pace, right? But when you are opening up a restaurant, you do have a risk of making losses initially, but then you do have a potential of generating supernormal profits also in a long run. This is what you will observe in this chart also. Can you see EPS1? It's growing. It's definitely growing, sir. It's growing at a linear phase and reaching up to EPS of 5. But on the other hand, if you observe EPS of 2 and EPS of 3, at a 10,000, can I say they are giving you higher earnings per share as compared to the plan 1? Can I say risk was high in EPS 2? Sorry, risk was highest in EPS 3. Correct? But we are able to get a higher rate of EPS also. Let me just show it to you by way of a chart. Can you see the chart, guys? Yes. Are you able to see the chart? I just expand it a bit. So this blue line is actually indicating the first plan. Can I say where is the starting point of the first plan? Can I say 0? You start from 0 and whatever sale, whatever EBIT is generated, that contributes to your profit. That just keeps on increasing linear. Right? What about the orange line? You can see orange line starts at a bit lower because initially there are losses. But then a point comes where you see the orange line is intersecting the blue line. Are you able to see that? There's a point where orange line is intersecting the blue line and it crosses up and then it goes up. Correct, guys? So beyond this point of intersection, the plan 2 takes a lead, and plan 2 is actually working out to be a better plan as compared to the plan 1. But then we have a superhero over here, a Milkha Singh over here, where it starts from a very negative rail. Right? It starts from a very negative rate, consistently rises. First, it crosses the orange line. Sorry, first it crosses the the blue line, which is plan 1. Then it crosses the orange line, and then it just keeps on rising. Correct? So, if I ask you, out of these 3 lines, which line is having a greater degree of slope? Which line has a greater slope? The green one, right? Because it's rising at a very faster pace. C will run. C is going to be a better option, or plan 3 is going to be a better option only for higher EBITs. For mediocre EBITs, you may have this orange line for you. And for very low level of EBIT, you will have EPS of, or you will have the first plan. 2 plan, right? Now, can I say that the indifference point which we computed was actually an indicator of the break-even point, financial break-even point that we computed was actually an indicator of risk that a company is having in its financing. A lower break-even point indicates that you are having a lesser degree of risk. Okay. Whereas a higher break-even point means you need to push more, you need to put more efforts, you need to generate good level of EBIT, not good excellent level of EBIT to get profitable. And that indicates again you are having a greater degree of risk. So why are we computing financial break-even point? To calculate which of the plans are having greater risk and which of the plans are having lesser risk. Are we good, everyone? Yeah. Okay. Now, in this chart, in this typical chart that we have, don't you think, I'll upload this file, Omkar, don't worry. This file will be there on the portal in the notes section. Don't you think it will be really interesting for us to know which is the point at which the intersection is happening? Right? Don't you think we should be, it will be interesting for us to know, sir, which is that point at which the intersection is happening, where the blue line is cutting the orange line, or the orange line is cutting the green line, or the green line is cutting the blue line. It'll be interesting to know what are those points where, they are intersecting each other. Okay. Now that intersection point we will be discussing in next session of ours. So let that be a suspense for you. We'll be discussing that intersection point in the next session, which is tomorrow. Okay. So now it's time for us to take your question and answers. Let that be a suspense, how to get that point. We'll take it up in tomorrow's class. Okay, let me take up your queries now. Yeah, Rachna.
Sir, I wanted to ask something about the chapter 4.
For the?
Of chapter 4, sir.
Chapter 4, which is that chapter? I don't remember the chapter by number. Name me the
Cost of capital, sir. The
cost of
previously
capital.
done.
Yeah.
In that, we had something called amortization of bond.
Okay.
So what is that, sir? Amortization of bond?
I think that is what you've covered in foundation also. Amortization of bond is basically repayment of the principal along with the interest. Right. So anyways, that will be covered in our revision class also. We have, I think, 1 or 2 sessions on cost of capital. So we'll be discussing about that there.
Okay, sir. Thank you.
So that is covered in foundation, CA foundation. But I don't know, if you don't remember, we can join the revision class. There we'll be discussing about.
Okay.
सर
हाँ देख
सर जो आपने PDF अपलोड करी थी असाइनमेंट के लिए सर उसमें क्वेश्चन नंबर 6 में सर डेटा इनकम्प्लीट है
क्वेश्चन नंबर 6 में
सर उसमें
कॉस्ट ऑफ कैपिटल
हाँ जी सर
क्वेश्चन नंबर 6 में डेटा इनकम्प्लीट है
हाँ जी सर उसमें सर आपने पार्ट्स तो दे दिए लेकिन सर आपने उसमें वो नहीं बताया कि प्रेफरेंस कितना है कैपिटल कितना है
एक सेकंड कौन सा क्वेश्चन नंबर 6 में क्या हो गया डिफाइन द वेटेड मार्जिनल कॉस्ट ऑफ कैपिटल
सर इसमें मैं निकाल तो लूं लेकिन सर वो नहीं बताया डेटा
क्या नहीं मिल रहा है
सर जैसे ये है ना इक्विटी शेयर कैपिटल कितना है रिजर्व्स एंड सरप्लस वो सब नहीं दिया हुआ
It raises 10 crore next year given the following information. The amount raised by equity equal proportion to the company extended 1.5 crores. Additional equity shares will result in net price being fixed at 32. The net expected dividend on equity. ये cost of equity तो दिया ना यहाँ पे?
नहीं सर कॉस्ट तो निकल आई है कॉस्ट तो मैंने सबकी निकाल दी लेकिन सर अब ये वाला जो पॉइंट है जैसे द डेट कैपिटल रेज बाय द
टर्म लोन हाँ
सर इसमें वो नहीं था एक मिनट सर
क्या नहीं दिया
अच्छा सर इसमें सर कॉस्ट ऑफ हाँ ठीक है सर इसमें सर मेरे को सर गलती लग गई नहीं सर क्वेश्चन 8 है नहीं सर क्वेश्चन 8 है गलती नहीं लगी सॉरी सर सर वो मैंने
हिस्ट्री
मार्क
दिया, बीटा दिया, मार्केट रिस्क दिया, इससे तुझे कॉस्ट ऑफ इक्विटी मिलेगा।
हाँ जी सर, कॉस्ट निकल गया इसमें, लेकिन वो नहीं है इसमें सर। इसमें पॉइंट नंबर सी है, उसमें लिखा है हाउ मच कैन बी स्पेंड फॉर
हाँ,
कैपिटल।
ये अभी एक इंटरेस्टिंग पॉइंट है।
इसमें सर वो डिवाइड करके निकालना पड़ता है ना वो एडिशनल कॉस्ट।
हाँ, उसके लिए
तो
रिवीजन
वो
क्लास
सर
अटेंड
उसके
करना
लिए तो
पड़ेगा।
चाहिए डेटा।
उसमें रिवीजन क्लास अटेंड करना पड़ेगा इसके। ये
नहीं
क्वेश्चन
सर,
वहां
वो
पे
मेरे को
कराऊंगा।
आता है निकालना, लेकिन सर डेटा इनकम्प्लीट है।
डेटा इनकम्प्लीट किधर है?
सर वो इसके लिए मेरे को चाहिए ना नंबर ऑफ शेयर्स कितने हैं, कि क्या मतलब क्या प्रेफरेंस है, कितना ऑलरेडी।
बिफोर ऑर्डिनरी शेयर्स। अच्छा हाँ, वो डेटा प्रेफरेंस विद एनुअल डिविडेंड, मार्केट प्राइस। अच्छा, इसका इक्विटी का ये नहीं दिया ना?
यस सर।
हाँ ठीक है, इसको मैं चेंज करके डालता हूँ मैं।
हाँ सर, ये बस था। वो सर मैंने क्वेश्चन मार्क करके रखा था, वो गलती से गलत बात कर लिया।
हाँ ठीक है ठीक है।
थैंक यू सर, बस यही
यस
था डाउट।
यस 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 सनातन।
हेलो सर। सर माय
बोल भाई,
क्वेश्चन इज,
पनवेल कहाँ जाना है तुझे?
हाँ सर, मेरा क्वेश्चन था कि सर रिविजनरी बैच को लेके एक
क्या क्या?
क्वेश्चन था। रिविजनरी बैच जो आपने ट्यूसडे को किया था ना
हाँ
सर, उसमें आपने लिखा था कि सेल्स माइनस सीओजीएस इज इक्वल टू ऑपरेटिंग ऑपरेटिंग कॉस्ट,
ऑपरेटिंग
देन
सेल्स माइनस सीओजीएस इज ऑपरेटिंग प्रॉफिट। जीपी बोला रहेगा।
ऑपरेट प्रॉफिट या फिर कुछ। सर हम लोग तो जानते हैं सर, सेल माइनस सीओजीएस से तो ईबीआईटी निकलता है डायरेक्टली, है ना?
सेल्स माइनस सीओजीएस से ग्रॉस प्रॉफिट निकलता है बेटा।
सर
सेल्स
उसी
माइनस
को तो हम
सीओजीएस से
EBIT
ग्रॉस
कहते हैं।
प्रॉफिट निकलता है। ग्रॉस प्रॉफिट में से यू विल सब्ट्रैक्ट योर अदर ऑपरेटिंग एक्सपेंस, देन यू विल गेट ईबीआई।
सर विच काइंड ऑफ ऑपरेटिंग एक्सपेंस सर?
हाँ,
Which kind of operating expense?
like your admin expense. COGS में admin expense you don't have, right? Admin expense, selling and distribution expense.
Selling and distribution expense and administration not considered. So those kind of expense.
Selling and distribution expense and admin expense both will be subtracted from your gross profit to come at the operating profit, which is EBIT. Got it?
Okay, sir.
Yeah. Yes.
यस सर। आई सर, ये जो हमने अभी ब्रेक इवन पॉइंट का कॉन्सेप्ट पढ़ा था
कौन से?
सर, इसका इनडायरेक्टली यही मतलब है ना कि ईबीआईटी जैसे जैसे इंक्रीज होता जाता है हम उतना ही डेप्थ पे रिलाई कर सकते हैं अपने ईपीएस को इंक्रीज करने के लिए।
हाँ, प्लान कौन सा चूज करना है टू इंक्रीज योर ईपीएस? यस।
तो मतलब जितना ईबीआईटी इंक्रीज हो रहा है उतना ही हम मोर डेप्थ पे रिलाई कर सकते हैं। ओके, थैंक यू सर, दिस वाज माय क्वेश्चन।
Sir, I want clarification in first plan in this जीरो से स्टार्ट करना है और फिर मतलब कि हमारा रिस्क होगा वो कम होगा,
क्या क्या क्या?
है ना सर?
इसमें किसमें रिस्क कम होगा?
प्लान नंबर 1।
हाँ, प्लान 1 में रिस्क कम है, बिकॉज वो अगर आपने ईबीआईटी कुछ भी कमाया, आप ईपीएस तुरंत कमाना चालू कर देते हैं।
यस सर।
राइट,
फिर
बट प्लान 2 और 3 में आपको नेगेटिव फेस करना पड़ता है।
यस सर। और प्लान 3 के अंदर हाई रिस्क है, लेकिन आगे जाकर हमें उससे भी दुगना
हाँ,
प्रॉफिट
रिस्क
हो
ज्यादा है
सकता
बट
है।
आगे जाके इश्क होगा, आगे जाके प्रॉफिट होगा। ठीक है।
यस सर, यही क्लैरिफिकेशन चाहिए था। ओके सर।
हाँ यस हार्दिक।
सर एक स्मॉल डाउट हो रहा है सर। जैसे हमारे होता है कन्वर्टेबल डिबेंचर्स होते हैं, तो हम उनको शेयर्स दे देते हैं, तो उनकी जब कॉस्ट ऑफ निकालना होता है कैपिटल, तो सर उसमें ना एक मैच्योरिटी पीरियड आता है। तो सर यूजुअली जैसे एक एग्जांपल ले रहा हूँ मैं कि कॉस्ट ऑफ जैसे कन्वर्टेबल डिबेंचर्स है, दे हैव अ मैच्योरिटी पीरियड ऑफ 5 years एंड आफ्टर 5 years दे विल बी कन्वर्टेड इनटू इक्विटी शेयर्स। तो सर उसमें हम सर 4 क्यों लेते हैं? उसमें जब हम जैसे कॉस्ट ऑफ कैपिटल हम जब निकालेंगे तो उसका ग्रोथ रेट दिया होता है यूजुअली, तो सर उसमें हम 4 लेकर करते हैं, एक कम कर देते हैं हमेशा।
4 लेके करते हैं मतलब?
मतलब सर जैसे मैच्योरिटी पीरियड दी हुई है 5 इयर्स का कन्वर्टेबल। कन्वर्टेबल जब हम उसको करेंगे तो उसमें ग्रोथ पीरियड दिया होता है शेयर्स का कि इतने साल के बाद ये रिडीमेबल वैल्यू निकालने के लिए उसका। तो उसमें जब हम उसको मल्टीप्लाई करते हैं ग्रोथ के लिए, उसमें हर एक क्वेश्चन में मैंने देखा कि उसमें एक ईयर कम लेकर करा है।
एक ईयर तो नेक्स्ट ईयर का प्राइस दिया रहेगा।
अच्छा, वो इस रीजन से कि नेक्स्ट ईयर का प्राइस।
हाँ, नेक्स्ट ईयर का प्राइस दिया मतलब प्राइस P1 हो गया एंड यू वांट P5 तो 4 बार ही पावर करेगा।
ठीक है सर, यूजुअली नहीं तो पूरा मैच्योरिटी 5 ही होगा।
हाँ, अगर करंट मार्केट प्राइस है तो फिर उसको
मतलब D0 एक तरीके से जैसे डिविडेंड में D0 होना चाहिए।
यस यस यस, वही D0 D1 वाला।
ठीक है सर, थैंक यू सर।
ओके, कॉस्ट ऑफ कैपिटल अपलोड नहीं हो, करता हूँ। in cost of capital, what is the IRR formula given in the study material? That is same जो हम लोग करते हैं between the two rates. You can use it between the two rates. There is no problem in that. Or you can by heart that formula and do it. That is your choice. Yes, ओमकार।
सर मुझे मार्जिनल कॉस्ट ऑफ कैपिटल समझ में नहीं आया सर चैप्टर 4 में से।
मार्जिनल कॉस्ट ऑफ कैपिटल कुछ नहीं बेटा, जो एक्स्ट्रा कैपिटल लेके आएगा उसका कॉस्ट। मार्जिनल मीन्स व्हाट? एडिशनल, एक्स्ट्रा। तो एक्स्ट्रा पे जितने शेयर्स या डिवेंचर्स इशू करेगा, you take only weighted average of those. That will be your marginal cost.
सर स्टडी मैट में पीवाईक्यू में क्वेश्चन है सर, वो भी समझ में नहीं आया सर मुझे। पीवाईक्यू में सर क्वेश्चन नंबर 5 है स्टडी मैट में।
उसको विल कवर द क्वेश्चंस इन रिवीजन क्लास। उसमें कॉस्ट ऑफ कैपिटल का जो रिवीजन क्लास होगा वहां पे वो सब डिस्कस करेंगे।
ठीक है सर, थैंक यू।
Okay. So with that, let's just stop here for the day. Good night. Happy Friday night. See you again tomorrow. Bye-bye, guys. बिना फॉर्मूला के आपने जैसे बताया कर सकते हैं। Yes, you can do it, पल्लवी। चलो, good night, guys. Joy.